Anita, welcome. And you have been out there for some time. On the more hawkish end of things, I would say just saying this inflation problem is real. The Fed needs to react to it. So what do you think happens now? I mean, are you at 25, a hike, a meeting still for the rest of the year?
I am, and that's been the message from Fed officials so far. Stay the course, hike as planned, and then continue to reassess. We know what the first order effects of this are, and that's that, prices at the pump are going to go up and consumers are going to have to pay more. As of right now, when we run, what energy prices have done through our inflation models, energy is on track to add about 0.3 to the CPI in February and 0.1 in March, and then actually turn around. But in the near term, I mean, this is clearly an inflationary, shock. Medium term, it's less clear, right? Yeah. Because we just don't know how consumers are going to respond, right? Are they going to stop spending on other things and sort of turn this into a disinflationary shock, which is, by the way, what they would have done over the past 20 years? Or are things different now? Are they going to dip into savings, or are they going to just demand higher wages, turning this into more of an inflation wage spiral? We just don't know that. I'm sort of leaning toward the latter, but yeah. If I was a Fed official right now, I certainly wouldn't want to prejudge or act on a hunch. So I think it makes sense to move gradually, predictably, and just continue to reassess.
Let me ask you about a couple of the dovish arguments making the rounds. I'd be curious for your take. We talked to Tom Porcelli yesterday of RBC, and he said that the shift from goods back to services spending is going to be disinflationary this year. Would you agree with that? And if so, how disinflationary?
I actually don't expect, I do expect the gap between goods and service spending to narrow, but I don't expect it to close entirely. I think that households are generating enough income from wages, from employment, and frankly, they have a lot of savings that they could dip into, that I think there's enough income growth to allow service spending to continue to normalize without pulling down on goods spending. So my base case is that goods spending just essentially flatlines here, but does not pull back. And so that means that if we're going to relieve some of these pressures in the supply chain, they're going to have to come through just increased imports, increased production. The good news is that we've seen some improvements. Imports absolutely surged in the fourth quarter. We've seen some buildup in retail inventory. So supply is catching up to demand. But I think that's sort of where kind of most of the work is going to have to be done. It's not, I don't think we're going to get much relief from weaker consumer demand.